discuss the business finance. So after that, uh, go for auditing. So few items will be touched in the concept, in the unit auditing. That is my plan. So first we will complete business finance. So I will share the document. Hello friends, my document is visible or not? Uh, Any trouble in both voice and also sharing of screen?
Sir, visible, sir. Voice
Yes, visible.
little bit,
Vo-
it's not good, sir.
Voice is not clear, ma'am.
Yeah. Now okay.
Yes.
Sometimes
Now
some
okay.
shoulder.
Yeah. Okay, ma'am. Okay, ma'am. If any trouble in my voice, you can say, ma'am, so that I will manage the.
Yes, sir.
Uh, yes, ma'am.
Yes, sir. Yes, sir.
So yes, ma'am. Thank
Good
you, ma'am.
evening, sir.
Very good evening, ma'am. So in today's class, we have to see business finance. I will say it is yet another interesting subject. Some few concepts we have to understand, like capital cost of capital, leverages, operating leverage, financial leverage, and capital structures, capital budgeting. These are all the things they will ask in your examination. So, like financial, like accounting, this easy easy unit that will contribute for more for your examination. So they will ask theories, the dividend policy theories, the assumptions. You should not ignore the assumptions in the theories. So that is very important. So you have to make hints. So that will be more helpful for your examination. So whatever the things we are discussing, so always you have to keep a note and you have to record the things. So that will help you for your examination. And I'll say what are the important things in the class. So that is also your questions will be centered around those concepts. So everything will be portrayed in the slide. Nothing is left out. All the syllabus is covered. So let me explain what is finance. So finance is using of funds in your business. So it is an allocation of money. It is an allocation of money. What is business finance? So as you know, business finance simply refers the utilization of money. How you are acquiring the funds, in what way you are acquiring the funds, and the acquired funds are utilized for what purpose? That is what I'm saying. The source and application. How you are getting the money, that is getting the money means you can acquire the money by way of loan or by way of issue of bonus fund, that is issue of equity capital or preference capital or even debt capital. So the source may be of different ways. and how these sources are optimally utilized. Uh, For working capital, see, the utilization may be two types, correct? And even in the source of fund may be two types. So source of funds may be owner's fund, another one is a debt fund. In the same way, the utilization may be of two types. One is current, the working capital. Another one is fixed capital. So you can utilize funds for two purpose. One is for working capital purpose. Another one is fixed capital. That is for machinery, land, trademark, copyright, like that. For fixed assets, you can utilize the funds. So this will be used in the financial management or business finance. This is a basic things I am saying. See, in one side you are getting the funds. How you are getting the funds? In two way. Kindly note the two way. The one is owner's fund. Owner's fund means what? Two things. One is equity capital. Another one is a reserve. Then fixed interest bearing set. Pay interest. You have to pay interest even though you are not getting profit. Even though you are incurring loss, you have to pay dividend. So, you have to pay interest. So in two way you can segregate your source of fund. One thing I told, one as fund. Another thing is loan fund, borrowed fund. In that you will be having debenture and another one is bond and even long-term loan from the banks, financial institutions. But I'm coming to another side, that is your application of fund. You are getting funds and how you are optimally utilizing the funds. This can be utilized in two ways. One is for working capital, another one is for fixed capital. So working capital means short-term investment and fixed capital means long-term investment. Okay. So what are I told, again I'm telling for your easy understanding, what is business finance or financial management, both are same. So I told, business finance is how the activity, the manager, how utilizing, how he is acquiring the funds and how these funds are converted into assets or for in order to meet out your business needs or in order to achieve your goal, business goal. So what is our goal? As you know, maximization of profit. So that is the primary goal of the financial management. Other things are subsidiary. So what is the primary goal? In order to maximize the profit, to maximization of profit, as well as maximizing the shareholders wealth. Shareholders wealth means what? Kindly note, shareholders wealth means that is equal to increasing the market value of share. Correct. When I'm saying maximizing the shareholders wealth, that is equal to increasing the market value of shares. So both are same only. So when you can maximize the wealth of the shareholder, in case it will be quoted at the share market, if your company's shares are quoted well at the higher price, then you can say the shareholders wealth are higher. Correct. So this is the objective. So now, what are the two things I told you? These are all the primary objectives of financial management or business finance. One is profit maximization. So you have to increase the profit. You have to increase the profit. That is a primary goal of any organization. Any organization may be tangible or intangible. They are producing tangible or intangible. Whatever may be the nature of the business, invariably all organization, all entities will be focused on increasing the profit. Right. But coming to the point, here profit can be maximized, right? But the point is very vague. The profit here refers in the financial management is very vague. So whether the profit relevant to notional profit or economic profit or net profit or operating profit or return on investment. So what is the profit? The profit may be different types, the profit may be return on investment. It may be return on investment, or it may be net profit, or it may be profit relevant to operating operation only. operating profit, or the profit will be notional profit, or the profit will be economic profit. So the the profit itself a vague one. It is not very clear. So that you have to keep in your mind. But whatever may be the thing, the any organization want to maximize profit. That is their ultimate goal. That is their ultimate aim. For that, they will seek for possibilities in order to maximize the profit, right? Okay, why I'm saying those things, they will ask why we are saying the profit is vague. The reason is, I told, you can't say, you can't pinpoint the profit, so it will be a vague one. It is a very exclusive term, not a inclusive term. So that is a problem here. And next, I'm coming to wealth maximization. As you know, just now I told wealth maximization means what? Kindly hint. What is the hint? Shareholders' wealth, or what is a shareholders' wealth? Or increasing the market value of shares. That is how you can maximize shareholders' wealth. So if the price of the share, if it is a higher price at market, it is higher price, so you can say wealth maximization. And next, I'm coming to why we are studying financial management. So very simple, two things only, again and again I say. So what is financial management? The best possible way of acquiring funds. Next one is the best utilization of the funds. Funds here refers what? Money, investment. So how you are investing the funds in a optimal way. That is the purpose of financial management, right? Those things we have to cover. Then the for net examination, it will be okay. We have to cover only those areas. Okay. Now I am saying what are the importance of financial planning. So financial planning means you are a long-term long-term proposal. So for what purpose you are you are requiring funds? So that is financial planning. So in order to ascertain the requirement, so for a short-term fund, how much needed? For long-term fund, how much required? So that will be monitored. That will be assessed. So that is first aim of the first need of the financial management, right? So utilization of fund. So after planning the funds, how these funds can be acquired, whether they are acquired by way of direct distribution, or they are acquired by way of financial institutions, or by way of debt capital. So how this will be acquired? I told, if you are acquiring the funds only through one method, it will be good. It will be risk free. But what is the thing here? The problem is you have to pay more dividend. For getting more profit, you have to pay more dividend, right? Whereas in the case of debenture fund, as you know, it is a tax free fund. Why I am saying debenture fund is tax free fund, but shareholder fund are not tax free fund. It is subjected to tax. But debenture funds are tax free funds. So that will decrease the liability of tax of any organization. Will I be able to elaborate? The reason is, this is a basic one. By understanding this basic one, then only we can see the capital structure, the dividend policy, the leverages, all are centered around the basic things. So if you are understanding the things, then it is okay. Otherwise, I will tell you in the elaborate way. Why I'm saying the debentures are tax-free funds, but shareholder fund are subject. It is tax, that will be a tax liability. Why? Can you say anyone?
Because it's a long-term debt, sir. Debentures is a long-term loan or debt sort of thing.
O- Okay, ma'am. But equity share also long term. Even you can repay the equity capital what only at the time of winding up. Correct, ma'am. Only at the time of liquidation. It will be repaid only at the time of liquidation, ma'am. Even debenture will be repaid within 10 years, ma'am.
Yes, sir, but we pay interest to them, sir. It's a sort of a loan.
But in the equity capital, you have to pay dividend, ma'am.
Yes, sir.
Dividend. But here it will be interest. I'm saying about the tax liability, ma'am. Okay.
Yes, sir.
Any other? Okay. I will tell the basic things, ma'am. I'll tell the basic one. Kindly note, please. See, first you will get profit before depreciation. Sorry, you will get first you will get profit before depreciation. Correct. Profit before depreciation. In that, you have to reduce the depreciation. Correct. So, what is the answer? Profit after depreciation. In this profit, you have to this is known as profit after depreciation, or otherwise known as EBIT. What is EBIT? EBIT otherwise known as what? EBIT is otherwise known as or EBIT. EBIT is
EB, sir.
otherwise yes, ma'am. EBIT is otherwise known as what? Otherwise known as
Earnings
uh,
before interest interest.
operating profit. Correct, ma'am. It is otherwise known as profit. The EBIT is otherwise known as operating profit. In that, what we have to reduce the interest, debenture interest. You have to pay the debenture interest. So this is profit, profit before tax. So what I'm saying, in the profit, you have to deduct depreciation. So that profit is before interest. That is EBIT. I told you, earnings before interest and tax. Before, not after. Before, or it is otherwise known as operating profit. It's a debenture interest. So this profit is called as profit before tax. Of correct. In this profit, you have to reduce the tax. You have to reduce the tax. So kindly you have to note my point. That is, you are paying the tax after deduction of debenture interest. Correct. Suppose if your profit is say 100 rupees, you are not paying any interest. You have to pay tax for 100 rupees. Do you accept or not? You have to pay tax for 100 rupees. Your debenture interest is 60 rupees. Your tax liability is declining. Your profit profit before tax is reducing. So your tax liability is less. What is the profit before tax? 40 only. So you have to pay profit on the 40 rupees only. So if you are paying interest, if there is any obligation in the form of interest, your profit will be, your tax will be lesser. But after this, you have to pay the tax. So after this is profit shareholders. This is profit available to shareholders. In this profit, for dividend to preference shareholders, we have to pay dividend to the preference shareholders. After paying dividend, this is a profit available to, as you know, this is a profit available to equity shareholders. This is a profit available to equity shareholders. the ROI, return on earnings. So return on earnings, you can have this to equity shareholder only. Correct, friends. You have to compute only profit available to equity shareholders. In this profit available to equity shareholders, you have to reduce reserve. You have to reduce reserve. So note, if your dividend rate, if you are paying dividend more than 10, suppose one share is 100. If you are paying dividend 11, 12, 13, like that. So above 10%, kindly note, above 10%, you have to allocate 2.5 percentage as reserve. You have to allocate 2 point out of the profit. You have to allocate 2.5 percentage as reserve. Paying dividend above 10%, above 15%. I told you no, up to 10%, no reserve, no general appropriation of general reserve is needed. As per Companies Act 2013, I am saying these are all the question asked in your examination. Even in the subsequent will be coming. But for your prior intimation, for your prior knowledge, I am portraying the oral idea. Then my task will be simple. It will be easy to discuss the points. So I have to say the basic thing. Grasping the basic things, then other things will be easy. Okay. So again, I'm telling profit before depreciation, profit after depreciation, less debenture interest, EBIT, that is profit before tax, less tax, then profit available to shareholders, less preference, in that less preference dividend. The outcome is profit available to equity shareholders. In that, you have to reduce the reserve. What is the reserve? Again, I'm telling, up to 10% of dividend. If you are paying 10% as dividend, suppose if you are holding 1,000 rupees, 1,000. So what is the 10%? 100. So up to 100, no reserve is mandatory. No reserve is obligatory. So no need of any appropriation of reserve up to 10%. So 10 to 15%, 2.5% is everyone. So each company should appropriate 2.5% will be transferred to general reserve. If it is more than, if it is more than 15%, 5% of the reserve, 5% will be appropriate for the reserve. If it is up to 20%, 10%, up to 20%. If you are if they are paying dividend 20%, so dividend 20%, 20%, what is the reserve? 10% is the reserve. So this is a rule. This is a rule as per Companies Act 2013. So you are appropriating the reserve. You are transferring the reserve. So after reserve only, you will pay the dividend. This is dividend. So this is dividend. This is the order. This is order. So why I'm saying this, the reason is, see, if you are paying debenture interest, yes, there is a beneficial of reduced, there is a benefit of reduced tax. So after paying tax to the government only, you are paying debenture dividend. Sorry, you are paying the preference dividend or equity dividend. So preference dividend, equity dividend, no way it is treated as the expenditure for tax income. So for taxable income, it is not reducible, but a debenture will reduce the taxable income. Do you agree my point or not? Could you able to understand? See, after the tax incidence only, so it is not paid before tax. It is paid after tax. After payment of tax only, we are paying dividend. That is the reason. Tax deducible. I told you, no, debenture interest is tax deducible. Whereas preference dividend or equity dividend is a non-tax deducible. It will not reduce your tax burden. Which one? The share dividend. So that benefit will be there. The benefit in between the equity dividend and the debenture dividend. Could you able to understand, or once again? It's not
Understood, sir.
understood. Correct, ma'am. Okay. Okay. So that is the reason why I'm saying uh, acquisition of fund or accordingly you have to plan. See what is the advantage of debt fund. It is tax deducible. You can have the tax. You can reduce that tax. Whereas in the case of equity dividend, you couldn't reduce the tax. It is not tax deducible. Okay. And how you can utilize the funds, financial decisions. I told for which investment you have to make, profitability, and finally I told increasing the value of firm. So that is a major purpose of the company. So in order to shareholders wealth, shareholders of the firm means what? Increasing the value of share at the share market. At increasing the value of one's shares. So that is another goal. What are the source of fund? I told these are the source of fund. Equity capital, preference capital, debentures, bond, long-term loans, fixed deposits. So these are all the. So what is the difference between debentures and bonds? If the debentures within 10 years, that will be if it is more than 10 bonds. Both are acknowledgement for fund. Even debenture or bonds are acknowledgement for loan, acknowledgement for the based on the terms, based on the period, you can categorize the debenture and bond. So again, I'm saying what are the source, how you can acquire the fund. I told, and what are the short-term source? Short-term source, as you know, bank loan, OD. What I'm saying, OD, bank overdraft. That is the arrangement of bank over and above the your limit, over and above the your credit balance. You can withdraw beyond your credit balance. That is known as OD. As you know, OD is available only to current account holders. It is not available to set deposit. Correct. It is available only to the current account holders. That is the businessman. OD. Customer advances. Trade credit. Trade credit means here refers what? Bills pay. Bills payable. Factoring, as you know, it is an arrangement in between the client or the company with the factor. Factor is a person who will manage your bills receivable will be managed. Suppose if you are selling the sales, if you are selling the goods at, so that credit will be managed by the third person. That person is known as factor. Even you'll give advance up to 90%. You will have the advance. You need not wait for the maturity of the may be drawn for 3 months or 4 months. So you need not wait for 3 or 4 months. You advance to buy the factor. So what is the factoring? Factoring is the arrangement in between the company and the person. The person is known as factor, who is looking after all the receivables of the company. Even you will pay the advance for the bill receivable before the maturity of the bills. So that is known as factoring. As you know, what are the process of factoring? All the bills will be once a bill drawn, accepted by bills drawn and accepted. As you know, who will draw the bills? The lender, the creditor. Who will accept the bill? The debtor. So the creditor will draw the bill and the debtor. Correct. Okay. Then it will be all the after acceptance, the bill will be transferred to the even you might be knowing this, the factor will be recourse factor or without recourse or without recourse. So what is a recourse factoring and without recourse? Any idea? The reason is these are all the things they will touch in your examination. So that is the reason why I'm saying the points. What is recourse and without recourse? Two types. Even it is coming in the next pages, I think so. Any idea?
No, sir.
Okay, okay, sir. So recourse factoring means bad debts will be borne by the, if any bad debts, if there is any poor debts, if are credit sales only, it will be out. Case credit sales, any bad debts, any non-payment of bills, that will be borne by the factor. In case that arrangement is not made, that is without recourse. So two types based on the bad debts, based on the bad debts. So it may be recourse factoring, without recourse factoring. So bad debts are accepted by the factor, so that will be coming in the recourse. Without recourse means what? Bad debts. So the bad debts will be borne by the client only, the company only. So public deposit, company may accept the deposits. Money market instrument. What are the things coming on the money market? Call money, bills, so treasury bills, all are coming under money market. So the investment within the maturity of instrument within 12 months. So the instrument, the financial instrument matured within 12 months. That is known as money market instrument. If the instrument matured beyond 12 months, more than 12 months, that is known as capital market. So your market may be, financial market may be categorized into two. One is money market, another one is capital market. As you know, money market is an unorganized one. Even the Marwadis, Sets, Chettias, all are coming under money market. It is not an organized one, and you can't say any particular physical place for money market. So it will deal only the short-term financial instruments, whereas capital market, that will deal long-term financial instrument that you might be knowing. Stock exchanges. So stock exchanges are coming under the capital market. And one more thing I'm adding, the capital market may be of two types. One is a new issue market. Another one is a secondary market. So secondary market means what? The company. The company will issue the shares. First, primarily, it will issue the shares. So in the primary market, what is the basic one? That section in between the investor and the company. Correct. There will be dealing in between the investor, that is shareholder, the investor, and the company. Whereas in the case of stock exchange, that is a secondary market. In the case of stock exchange, there is no dealing with the company. The company will not involve. Will be made among the investor. Suppose if you are investing shares in HLL, you are the first seller. Uh, After acquiring the shares, it will be paid only at the time of winding up. Correct. The HLL will repay the equity capital only at the time of winding up. You can't say when the company will be winding up. So you have to wait for a long period. So without for the purpose of liquidation, you will sell the share, which is stock exchange. So the stock exchange is a place where you can sell your shares. So that is the reason why I'm saying it is a dealing among the investor for the liquidity purpose, for the conversion of shares into cash. So for that purpose, you can go for the stock exchanges. How many? So dormant, without dormant, actively There are, to- ma'am. Hello,
There
ma'am.
is some trouble in your voice. We cannot hear it clearly.
My my voice is not audible, ma'am. 1 minute.
Your voice is audible, sir, but it's getting a little bit down here and there. So we are
Echoing,
not able to, not echoing.
echoing,
It's
ma'am.
getting cut in between. So the voice is
Hello, ma'am.
not coming
Like
out.
FM, sir. Like FM.
Oh, breaking.
FM radio
One.
type. Picking.
Oh, okay. 1 minute, sir. Now, ma'am. Now the problem is okay, ma'am.
Yes, sir.
Hello,
Now
sir.
it's clear, but in between it gets cut. So that's when it gets cut. Probably I will inform you about it. Thank you, sir.
Sure, ma'am. Sure, ma'am. Thank you, ma'am. So we are discussing about the two things, that is one is stock exchange, another one is money market, right? So what is money market? There the only short term instrument will be dealt, whereas in the case of capital market, long term instrument will be dealt. Further, the capital market may be bifurcated into two. One is stock exchange, that is secondary market. Another one is primary market. So in the primary market, the company will issue the shares, debentures, and dealt in the secondary market, stock exchange. So I told how many actives, excluding dormant. You should not account for dormant. So 23 stock exchanges are there, that you have to understand. Even in your examination, they will ask the Bolt. Bolt means online trading. Bombay Online Trading. They are OTCA. So they will ask OTCA. OTCA means what? It will not be, the shares will not be dealt through online. Here you can buy over the counter exchange of India. So it will not be online. It will be counter. The shares will be dealt in the counter. That is OTCEI, over the counter exchange of India. As the name suggests, over the counter only you can buy and sell the shares. Okay. So we will discuss in. I want to give some basic idea about the concepts. Then capitalization. What session. You are pouring money for the business. You are investing money for the business. Correct. So it should be optimal. It should be optimal. It is a very crucial act of the business, crucial decision of the business. So if it is over capitalized, that is a problem, or it is undercapitalized, or that is also. So always capitalization will be optimal one. What is required for the business, that will be invested in the business, otherwise it will be a problem. Okay, what is capitalization? I'm telling, determining the fund, how much fund. So you are measuring the amount which is required for your running of business. And I told what are the types of capitalization: over capitalization, under capitalization, even water. I told. So watered capitalization. There is also watered capitalization. So I will say what are the different types of capitalization. If any difficulty in understanding the point, you can say. I will tell in a understandable way. Okay. So what is the over capitalization? As the name suggests, you are pouring money beyond the requirement. So what is required for the business? Beyond that, you are investing excess of the required one. So The money will be invested in excess of the your actual activity. Suppose your level is 80% only you are operating, but you are investing to the extent of 100%. So that is over capitalization. Suppose I'm explaining the concept that is not required for your examination. I'm explaining in beyond the level, extraordinary. That is not in the optimal level. That is the optimal capitalization beyond the requirement. What are the effect? As you know, in the case of war capitalization, your investment is more. Your investment is more, but the profit will be lesser. Then it will show a lower rate of return. That will show lower rate of return. The reason I'm telling the investment will be more, and the return will be similar. So the rate of return will be lower. Also, the difficulty in the getting the fund. So you are estimating higher capital. So if you are estimating higher capital and your estimated profit is low, in such a case, how they will give money? No profitability, no lending of money by the investors. So difficulty in acquiring the fund, that problem will be there, and your market price will be lower. If your profit is lesser, as you know, the price of the share will be uh, uh, linked with the profitability. So if your profitability is lesser, then your market price will be less. In that way, the wealth of the shareholder wealth will be lesser. So some effects are there regarding capitalization. What is the remedy? What is the remedy? As you know, redemption. So redemption of share capital, that is the best way. So for not to reduce war capitalization, you can redeem the share. What is the redemption? Repayment of share capital. So you can repay the shares. In that way, you can maintain optimal share. Reorganization of or rearrangement of equity capital, splitting the share capital. See, already you are having share. Now it will be 10 per share. Also, you can repay the debts or you can repay the loans. So these are all the ways by over capitalization. So under capitalization, just a reverse. So what is required? Invested in your money, but you are investing very lesser. Suppose your level of operation is 100. Your level of operation is 100%, but you are investing only 80%. So what happened? You are making use of the machinery, making use of the asset beyond the capacity, beyond the level. What happened? The wear and tear will be more. Some trouble will be there. Some mistakes will be there. So that is a problem in the case of undercapitalization. So undercapitalization, what is required? That is not kept in the form of a capital more than the required one. So what happened? The market value will be rising. In that way, the competitors will be more. If you are showing higher return, what happen? It will attract more competitors. So you have to face more competition. Even you have to pay more tax and also more government control. If you are having a higher return, the government will keep a check on the profitability of the company. So the government control will be more, and also the consumers feel that they are exploited. So what is coming in the minds of the consumer? They are charging more price. That is the reason why the company getting more profit. So these are all the evil effects of the undercapitalization. The major thing, the market price will be going up. So you are manipulating, that is not a real one. You are manipulating your price of the share at the market, at the share market. So that will not be a leveraged one. That will not be a standardized one. There will be a deep down. Immediately there will be a deep down. Why? You the capacity. You can't. I told immediately if you are using the machinery assets beyond its level, what happens? Will be down. So these are the some difficulties. So what is the resolution? What is the how you can resolve the problem? So I told in the war capitalization you have to repay. In the case of capitalization, you have to issue fresh capital. You have to issue fresh debentures. So that will be another solution for the problem. Even bonus shares. You can. What is bonus shares? Capitalization of reserve. So bonus shares is otherwise known as capitalization of reserve. Even the same word asked in your examination. That is the reason why I'm saying the keyword. So bonus shares means what? Bonus shares is otherwise known as you are converting the general reserve into capitalization of reserve. That is known as bonus shares. And I'm coming to water capitalization. So what is water capitalization? Part of capital not reflected in your balance sheet, not reflected in the balance sheet. That is known as water capital. Suppose I will say your assets is showing more value. Suppose I will say the real building value or the real land value or the real machinery value is 1 lakh. But how much you are showing in the balance sheet? 80,000. So that is 20,000 is the watered capital, the missing value. That is known as water cap. So how much the real value of asset is not reflected in your balance sheet. Clear. So that is known as water capital. So the realizable value of assets of the company is less than the book value. It is less than the book value. So the book value will be higher and the real value will be lower. So that will be a mismatching of the real value and the book value. That is known as a watered capitalization. Another important one asked in your examination. But you have to know the keyword. What is the keyword? Mismatch. Mismatch of the real value and the book value. Book value means a balance sheet value. So what is recorded at your balance sheet? That is known as a book value. Okay. What are the reason you are acquiring the asset more than the price, more than the real value? You are paying more. You are paying more for the assets, and you are adapting the depreciation. The depreciation you are charging lesser depreciation. What happened if you are charging lesser depreciation? What happened? The asset value will be more than the real value. Suppose the depreciation is 10, then the book value will be 90. Whereas I am charging depreciation only 8. So what is the balance sheet? It will be indicated as 92. So because of your poor adoption of policy, depreciation policy, it will be showing more. And intangible assets are no way useful for the company. They are trademarks, copyright. No way it is worth. It is worthless. And I'm coming to very important one. In this capital structure, it is very easy one. Uh, Your capital, I told, your capital means how much you have to invest in your business, how much you have to pour money for your investment, for your capital. That is known as capital structure, right? So, having understood the meaning of the term capital, now you have to find out the ingredients of the capital. What are the ingredients of the capital? What are the proportion? What are the mix? That you have to decide. That you have to decide. Suppose in my capital, I told you know my capital structure may be broadly into two. One is honest one, another one is debt fund. Only two, not more than this. Only two is available. Whether my component is optimal or not, whether I'm investing, whether I'm raising funds in a optimal mix or not, that will be decided. For that, various structures are there, capital structures are there, that capital structure theories are there, like modularity Miller approach, net income approach, net operating income approach. Some three approaches are there, very important, I'll say. Okay, without wasting time, I'll say what is capital structure, what is financial structure, that you have to find out the difference. See, capital structure refers only the capital. It shows capital only, the long term capital. So capital structure is composition, or the long term resources, whereas financial structure means both. It comprised of both the long term capital as well as short term capital. So that is known as financial structure. You can't say capital structure and financial structure are one and same. So how the funds are available for investment? See, certain assets can be acquired by way of long-term capital. Certain assets are acquired by way of short-term capital. Where that is called as financial structure. Whereas in the case of capital structure, it is relevant only with the long-term capital. Whereas financial structure, it is relevant with both short-term capital. What is a short-term capital? Working capital. So working capital also uh, the fixed capital, that is long-term capital. So that is called as financial structure. Whereas capital structure refers only these things. For your easy understanding, capital structure equal to equity capital, preference capital, then debentures. What is financial structure? Financial structure equal to equity capital, yes, preference capital, debentures plus working or creditors, current liabilities. That is financial structure. Okay, I'll go for optimal. For optimal, we have to see the theories. What are the theories? Uh, Three theories are there. One is modern theories, another one is traditional. So three theories are coming under modern, and the last coming under traditional approach. Okay. So in the modern net income, I told you know net income, net operating income, modiclonary Miller approach, approach. So what is a traditional approach? See, in the case of a traditional approach, it is a combination of both. It is a combination of net income approach and a net operating income approach. That is the reason why the traditional, it is a midway. It is not in the net income approach. It is a combination. It is a combination of net income and a net operating income. It is an intermediate. What is this traditional approach? The debt and equity capital can increase the value of firm up to certain level. Up to certain level. The combination will give more profit up to certain level. Beyond certain level, no way it is connected. It is not beneficial. So suppose I am saying, up to 1 lakh, up to 1 lakh. So here the combination is what? Here the combination is, suppose I am saying, here the combination is 70,000 debt capital, 30,000 equity capital. Up to this, it will be with the profitability of the firm. The profit will be more. But beyond this, beyond this 1 lakh, suppose 2 lakh. if your capital structure is 2 lakh. Whatever may be the combination, no way connected with the profitability. So 1 lakh plus 1 lakh, or for 2 lakh, I'm 1.5 plus zero point 0.5, or 75,000, 1 lakh 25,000. Whatever may be the combination, no way linked with the profitability of the firm. That is known as what approach? Intermediate approach. The keyword you have to find. So, whatever may be the capital structure, what is the optimal capital structure? Answer. What is the optimal capital structure? That is, optimal capital structure means less investment, more profit. So that is the optimal capital structure. It will yield more profit with your given investment. It will give more profit. So that is the optimal capital structure. So for that, we have to determine the mix. How much debt capital in your investment, in your capital structure, how much bonus fund in your capital. So that you have to determine. So what is the traditional capital? Up to certain level of capital, yes, there is a influence. There is a influence of the combination. But beyond the level, beyond certain capital, beyond certain investment, it is no way linked with the profitability of the firm. You can have any combination, even no without equity, or without debt, or higher of debt, or higher of equity. No link of the proportion. No, no necessity of seeing the mix. So that is known as intermediate method, or traditional method. This is one part. The another side, the assumption you have to keep in your mind. What are the assumption in the traditional approach? There are only two sources. One is debt fund, another one is share, equity share. Also, the company does not retaining any profit. It is not retaining any profit. All the profit given as dividend. All the profit given as dividend. Nothing is retained. Also, the total assets are not changing. In the given year, it is not changing. It will be stable. It will be constant. And the requirement of fund will be constant. It will not be changing. How much required for the company for investment, that will be constant. EBIT also not grow. EBIT means, I told, operating profit, earnings before interest and tax. I told while explaining the benefits of debenture, I told. So the operating profit, the EBIT will be constant. It will not grow. And the business risk will be constant. These are the assumptions coming under the traditional capital, traditional capital structure method, or traditional method. So what is the another name of traditional capital structure? Intermediate method. Now I'm going to net income approach. See, the net income approach, also net operating income approach, both are some way similar. Both are propounded by David Durant. They will ask the name of the theory. Who is proposing the theory? Who is the author of the theory? They will ask. So ND. Even the net operating income and the net income, both are propounded by David Durant only. So the author is not different. Both are same only. So net NI approach propounded by David Durant. So what is this NI approach? Very simple. Your capital structure is directly relevant with the firm, or the capital structure will be directly connected with the proportion, or the benefit, the profit of the firm. Suppose I am saying, in case more debt, if you are using more debt, your profit will be more. If you are using lesser debt, your profit will be lesser. So the profitability of the firm is directly connected with the usage of debt. That is known as net income approach. So again, I'm saying net income approach is otherwise known as relevant relevant theory. Why we are saying relevant theory? It is relevant with the debt capital. If you are using more debt capital, yes, the value of the firm will be more. Suppose I am saying, I told in my earlier example, I told I need 1 lakh capital. In that 1 lakh capital, I am using 80,000 debenture, 20,000 equity capital. This is one side. Another firm using 50,000 equity, 50,000 debt. Where the worth will be more, where the market value of the company will be more, or where the wealth of the shareholder will be more, the market value of the company will be more. In the case of 80,000, the case where I am using more debt and case where I am using lesser debt, the value of the firm will be lesser. So that is known as net income approach, directly related of debt capital. The same thing. The assumptions, same thing. No company tax. As you know, now there 15% is a company tax. These are all the things I will asking. So maybe I'm some way going in the irrelevant. It's not irrelevant. For exam point of view, these are all the things I will ask. The existing corporate tax is 15%. Okay, no corporate tax. The assumption is no corporate tax. And next one is the cost debt is less than the equity cost. The rate of interest. The rate of interest of debenture is lesser. Third assumption, the risk will not be changing. Be ideal. Financial. Okay, these are all the assumptions. David Durant net income approach. But whereas net, this is a formula. This is a formula. So what is the formula? S equal to, that is market value of equity is equal to NI divided by KE. What is NI? Earnings available to equity shareholders. KE equal to cost of equity. So this is a formula for computing the value of the firm. You can know the value of the firm out of the application of the formula. S is the value of the firm. So S equal to net income or the earnings available to the shareholders divided by cost of equity. Next, I'm moving into net operating income. If you are understanding net income approach, then a net operating income will be easy. Why? This is also suggested by David Durant, but it is very much reverse. The same David Durant, what he was suggested, there is no link. There is no link in between the capital structure and the worth of the company. So no way your capital structure affect the value of the firm. So you can have any proportion, even without debt. You can have the capital structure or lesser debt or more debt, any mix, any proportion, any ratio you can have, but no relation of the worth of the firm, market value of the firm. So that is another contrary uh, suggestion by same David Durant under the approach. What approach? Net operating income approach. NOI approach. I told NI equal to R. NOI equal to NR or IR. Irrelevance. Irrelevance. What is irrelevant? Structure irrelevant to which to your market value. Okay. So what is the form of the firm equal to EBIT divided by KE? Uh, how you can find the overall capital? Overall capital will be computed by adding KE plus KD. You don't worry. I will say what is cost of capital. I will say. So cost of capital means very easy. What is cost of capital? Interest. You have to pay interest. If you are paying interest for debt, that is KD. K base D. If you are paying dividend to your shareholders, that is KE. If you are paying interest for your retained earnings, that is KR. So for your usage of fund, how much you are paying in interest, how much you are paying as dividend, that is cost of capital. How much interest, that is cost of capital. So what is the value of the firm? Value of the firm equal to EBIT, operating profit, divided by KO. How you can obtain KO? The two cost of capital you have to add, the KE plus KD. And we are moving into approach. So approach is also a irrelevance theory.
Sir,
Yes, ma'am.
you were
Yes,
talking about KR. Can you please come again with that?
sorry, ma'am. All the different cost of capital coming in the next slide, ma'am. KE, KD. Displaying, ma'am. Could you able to see, ma'am?
Yes, sir. So thank you so much.
Cost of, yes, ma'am. Cost of capital for equity, cost of capital for preference. Okay. But I'm searching for a approach, ma'am. I'll check. It is missing, I think so. Approach. Yes, we gone through traditional NOI and approach is important. Honorary Miller approach. Uh, okay. Here. Okay. Yes. Be able to see approach.
Yes, sir.
Yes, sir.
Okay, ma'am. Okay, ma'am. So, approach, this is also irrelevant, ma'am. Equal to IR. I told net operating income. So, in the operating income approach, I told operating income approach relevant, but NOI irrelevant. In the same way, irrelevant. So what is that irrelevant? No relevance of your capital structure with your worth of the company, with the market value of the shares. So no way connected. The same suggestion, what is given by David Duran under a NY approach, net operating income approach. The same was suggested by approach. No way may have no debt or more debt or lesser debt or more equity, what maybe any no way connected with your worth of the firm, your value of the firm, or the market value of the shares. No way connected. That is what as approach. But it is not. Not proving the concept. The David Durant he couldn't able to proving the concept. In what working, in what way it is applicable. So no, it is not proved. Who the I don't know David Durant in the NY is not proving the concept, but whereas MM approach is proving the this irrelevance will be operated in the real share market. So that was proved by a process that is known as arbitrage process. So what is arbitrage process? Very simple. Kindly note when I am saying arbitrage, what you have to, what is coming in your mind? Modiclonary repeatedly asked in your examination. So in which process, or they will say in this way, arbitrage process is connected with which of the following theories? They will ask MM approach, the NY approach, NI approach, traditional approach. They will ask. So always MM equal to arbitration. So what is arbitration? Very simple. You are buying share in one market at lower price and selling the shares at a higher price in another market. So that is known as arbitration process. So in this way, your market value of the firm will be adjusted. It will be set off. So you are buying the share in one market at lower price. That lower price will be adjusted in another market. Why? In another stock exchange you are selling the share at a higher price, so it will be set off, it will be adjusted. So whatever may be your capital structure, it will not be reflected in your market value. So that is known as uh, it is a operational justification, but no justification given by David Duran. Conceptual, it is not operational, whereas this is operational. I told you, no, buying in one market. Here I will highlight the point. uh, Buying one at lower price, selling another at a high price. So by the way, the firm value will be constant. What are the assumption? Very important. The capital market is perfect. So capital market is perfect means what? There will not be any different in the capital market. It will be uniform. They are maintaining a uniform, perfect capital market will be maintained, and no retaining of reserve. 100% payout. 100% payout means what? All the profit will be given as dividend. No corporate tax. This will be, this assumption will be common for all the theories, not only capital structure and also a dividend policy. In the dividend theories also, this is the common assumption. And firms can classified as homogeneous groups. So higher risk, that will be category A. Moderate risk, that will be category B. Lower risk firm, that will be category C. So based on the risk factor, the firm will be categorized A, B, C. So these are the assumptions of MM approach. What is the limitation? So the limitation is the rate of interest are not same for the firms. So one firm may pay higher debenture interest, another company will pay lower interest rates. Whereas in the case of MM approach is assuming only similar return. I told you know perfect market. So perfect market means what? Similarity in all the market. Similarity, no heterogeneity, homogeneity. So is maintaining homogeneity in all the that is not practically possible. So suppose if you are buying the product, it will be at different price, you know. So you can't have I will say in our real world the perfect market is not possible. The uniform variety, uniform in economics, I'll tell what is perfect market, what is imperfect market, what is oligopoly, duopoly, monopoly. I'll tell those things are very important. You don't worry. Okay, I'll say the capital market is perfect. Perfect means what? Uniformity. So wherever you are buying, you can have the similar product at similar price. That is impractical. So that is the reason why it is placed at the top in the limitation. That's a demerit. And transactional cost will be that. Transactional cost means what? The dividend tax, the corporate, the dividend tax, the government tax, and the brokerage will be that. So those things are completely ignored under approach. Okay, right. So four structures I told. And next I'm moving into cost of capital. Okay. What is uh, what is cost of capital? Very simple. How much you are paying? How much you are paying for debentures? So that is cost of debt. How much you are paying for using shareholders fund? That is cost of equity. How much you are paying for the retained earnings? What is retained earnings? Anyone? What is retained earnings? Could you able to understand what is retained earnings? Retained earnings equal to, so retained earnings equal to the general reserve, the savings, the profit, the portion of profit not utilized for dividend. So that is known as retained earnings, the general reserve, reserve fund, dividend equalization fund, employee fund, all are coming under retained earnings. So how much you are utilizing the retained earnings for your expansion of firm? For that, the interest called as cost of retained earnings. So the cost of capital may be categorized in this form. So if you are paying for a debenture, that is cost of debt. If you are paying for equity, that is cost of equity. If you are paying for a preference dividend, that is cost of preference dividend. Okay. Now I'm saying what are the various categories of cost of capital. Explicit cost and implicit cost. Explicit cost means what? How much you are paying. Uh, but implicit cost means what? It is not expressed in economic. It will not expressed in money terms. The amount you are paying indirectly, that is it will not be recorded in your books of accounts. That is known as implicit cost. If it is recorded in the books of accounts, that is explicit cost. The pains, the strains of the owner, that will be coming under implicit cost. But you are paying a dividend, you are paying interest, that will be explicit cost. So expressed in the form of money, not expressed in the form of money, that is implicit cost. Average, marginal. What is average? The average interest you are paying. So you may having 10 percentage debenture, 8 percentage debenture, you may having 12 percentage debenture, you may having 6 percentage. Altogether, averagely, how much interest you are paying? That is known as average interest. Correct. That is average cost of capital. What is marginal cost of capital? In order to issue one more debenture, how much interest you have to spend? That is known as marginal cost. Suppose earlier, I'll give example. Suppose earlier I'm having 10,000. For that I'm paying 10,000 as interest. I'm paying 10,000 interest, for example. In case I'm issuing 10,000 more debenture. So what is now? What is my debt capital? 1,10,000. 1,10,000. For this, how much interest I am paying? I'm paying 11,500 as interest. So what is my marginal cost of capital? My marginal cost of capital is 1,500. So additional interest paid for additional raising of capital. So that is marginal cost of capital. Next, I'm coming for historical future. This already know, already past interest is known as historical, and what is your planned one? That is future. Okay, specific combined. Specific means what? Specific means I will say K means cost of capital. That I have to say. K means cost of capital. K base E base E. This is cost of equity. Base, sorry, cost base B. Base B. That is cost of debt. K base B. That is cost of preference capital. How much dividend I am paying for preference shareholders. That is cost of preference. What is combined cost? Combined cost means I am aggregating all. I'm aggregating all. If I'm aggregating all, what is my result? My result will be KO. KO means what? Overall cost of capital. KO. KO means overall cost of capital. So how many cost of capitals are there? I told you no. KE. KE means cost of equity. How much dividend I am paying for using the equity fund. KD. KD means what? How much interest I am paying for using debenture capital. KP means what? How much preference dividend I am paying in order to using the preference capital. KR means what? Retained earnings. How much interest I am paying in order to using the retained earnings. If I am aggregating all the four, I will get overall cost of capital. Overall cost of capital. In case I need average, so if I need average cost of capital, mean divided by the number of 3. This is average. So specific combined. Specific means KE. I'm saying KD. That is specific. Specifically, we are computing the cost of equity or okay. Combined means altogether. Okay. So here are the example for how you can compute formula. Very important. Formula for computing cost of equity. Very simple. K equal to the dividend you are paying. The dividend divided by net process. Net process means what? Face value of share minus broker commission or underwriting commission. So in order to float the equity share, how much a broker charge you are paying, how much underwriting commission you are paying. So par value, face value plus premium you have to add. Correct. Suppose a share issued at premium. Premium means what? Premium means over and above the face value. So what is the maximum permissible limit for premium as per in Companies Act 2013? What is the permissible premium percentage? Any answers? Or I'll ask in this way. What is the permissible discount percentage? For how much discount they will issue the
10%.
Very good, ma'am.
10%.
Excellent, ma'am. Excellent, ma'am. What about premium, ma'am? Premium percentage? Discount, correct, ma'am. 10%. What is premium?
No, sir, I have no idea.
No limit, ma'am. No limit. No limit. They will issue shares at any rate of premium, ma'am. No limit. But only thing is, if the shares are first of its kind, it should not be issued at premium. If you are issuing a share, first type, suppose I am issuing 8% preference share for the first time, I should not issue at a premium. That is a rule. If you are issuing shares for the first type, first issue, For that, you could not charge any premium. Okay. So plus premium minus discount on shares, plus, sorry, minus broker commission or underwriting commission. Okay. This is called as net profit. Correct. This is called as net profit. Net process. So net process means how much your money you are getting. Okay, dividend, the dividend divided by net proceeds plus the growth rate. So what is the expected growth rate in future? Maybe the growth rate may be 10 percentage or 15%. So this will give the answer for cost of equity. So cost of equity equal to KE dividend. It will, everything will be given in your examination. You don't worry. You need not compute anything. Dividend they will give dividend 100 rupees. Say for example, dividend 100 rupees divided by net profits is 900. Net profit, suppose 1,000 rupees is my equity share, minus paid for commission 100, so 900, plus growth rate. Growth rate 10 percentage, 10 percentage, 10 percentage, 10 divided by 100, 10%. So what is my answer? My answer will be 1 by 9. 1 by 9 means 11.1 plus the growth rate 10%. What is my cost of equity? 21.1%. This is my cost of equity. Could you able to understand, friends? By net process. Net process means my par value, face value plus any premium charge or any discount. So that may be deducted. Okay, discount will be deducted and commission will be deducted. So net profit plus the growth rate, it will be given in your problem. Okay. So this is a cost of equity. Next, I'm moving into cost of debt, cost of redeemable debenture. I'm moving into cost of redeemable debenture. Okay. What is the formula for redeemable debenture? So formula is 1 by redemption period. Redemption means if it is a redeemed for or after 10 years. So 1 by number of years, 1 by number of years into the difference between the par value and the net process. The par value and the net process. The par value means what? The face value. Net process, I told, just now I told net process. So the difference between the par value and the net process, all divided by the average. So the par value average means what? Par value net process divided by 2. So again I'm saying the formula, again I'm saying cost of debt equal to, I'll put here so that you can understand. Cost of debt equal to the interest, not in percentage. It should be in amount. That is very important. The interest plus par value or face value. Face value means what? How much you are issuing, the issued value, the par value minus the net process. Net process means after charging the commission. Net process divided by number of years, the redemption year. After how much year you can redeem the debenture, the redemption. The number of years you can, after that you can redeem the debenture, the n, all divided by, the average, the same thing. That is what? Par value plus net proceeds divided by average means what? 2. So this is a formula for KD. KD means cost of redeemable debenture. You don't worry about the irredeemable debenture. In India, there is no irredeemable debenture. So no debenture will be issued on irredeemable. So you don't worry about the irredeemable. No questions will be asked regarding irredeemable debenture. So you should be thorough with the redeemable debenture. So even I will say I will illustrate. Suppose you are paying interest, 1,000 rupees as interest, as your face value is face value of the debenture is 1 lakh. 1 lakh is your face value minus the net profits is 90,000. You are I am assuming 10,000 as a broker commission. So 90,000 divided by number of years. So for our easy calculation, I will take 10. So after 10 years only it will be redeemed. So I will take divided by 10 whole divided by the 1 lakh face value, 1 lakh face value plus the net profit is 90,000. Correct, 90,000 divided by the average 2. So what is my answer? Can you say the answer? 1,000 plus 1,000 is my interest plus the difference between the so what is that 1 lakh minus 90,000 divided by 10, that means 10,000 divided by 10, so 1,000. 1,000 plus, so what is the difference between net profits and par value? 10,000 divided by number of years, so 10,000 divided by 10,000 whole divided by the average. What is the average? 1 lakh plus 90,000 divided by 2. That means the average is 95,000. So now I'll be getting the cost of debt. So KD equal to 2,000 divided by 95,000. That means my interest rate is 2. So 2,000 divided by 95,000. I think 22 like that. So 20. So 22% is cost of debt. Clear? Is understandable or not? Any difficulties? Why I'm saying they will ask this type of questions. Okay.
Yes, sir. Understandable, sir.
Okay, ma'am. Okay, ma'am. So here, next I'm moving into cost of retained earnings. Cost of retained earnings. KR. I'm computing KR. So what is the formula for retained earnings? KE. KE we already computed, We already computed KE. I told what is the formula for KE? D divided by NP, net profits, plus the G percentage. That is the growth rate. So we already computed KE. So what is the retained earnings? KR. Retained earnings means, again I am saying KR means the amount you have to pay in order to utilize for the reserve capital. Okay.
Excuse me, sir.
Yes, ma'am.
I have a doubt here. So
Please.
retained earnings is nothing but the profit which we are getting. We are going to give some dividend to them, and the remaining is our retained earnings, right?
Yes, ma'am.
Why do we have to incur a cost on that, sir?
Ma'am, those amount are belongings of the shareholders, ma'am. So you have to pay bonus share, or you have to that amounts are available for the shareholders, ma'am. If you are utilizing the money, that will be cost, ma'am. Correct, ma'am?
Like what we are going to give them some sort of interest for that? Like how are
Bonus.
we going incurring the cost for like having something retained. That's my small doubt, sir.
Yes, ma'am. Even you are not paying, ma'am. Yes, I agree. You are not paying, but those things are for the shareholders, ma'am. In future, you can pay as bonus. Correct, ma'am. You can pay as bonus, or even I'll say, ma'am. In future, if you couldn't able to maintain the dividend, this money will be utilized, ma'am, in order to maintain the dividend. Correct, ma'am. Suppose
Hmm.
if you are paying dividend at the range of 10%. In case if you are incurring loss, this money can be utilized for paying dividend. So you can't, you should not touch the money. Correct, ma'am?
Okay.
So those amounts are available only for the shareholders, ma'am.
So we're making a provision for that right now itself.
Yeah, ma'am. Yeah, ma'am. That is the reason why that is called a shareholders fund, ma'am. What is a shareholders fund? Equity capital, not only equity capital, ma'am. Shareholders fund equal to equity capital plus retained earnings. Correct, ma'am. So
Okay.
those amounts are available for the shareholders only, ma'am. So you should not utilize the money for your investment. If you are utilizing the money, you have to find out the cost. Clear, ma'am?
Hmm.
Yes,
Yes,
ma'am.
sir. So
Yes.
we are finding a cost for that. Okay.
Yes, ma'am.
Okay.
Exactly,
Thank you,
ma'am.
sir.
Yes, ma'am. Yes, ma'am. But your question is right, ma'am. You are paying dividend out of only for the equity capital, ma'am. Even though the retained earnings is kept idle in your firm in order to balance your business. In if any risk or that, that amount will be utilized. But you are touching the money, for that you have to find out the cost. Okay. So what
Okay,
is
sir.
the
Sir,
yes, ma'am.
thank you.
Thank you, ma'am. Even I'll say elaborate my explanation, ma'am. Even if you are utilizing your own money in the form of savings, you need not pay any broker commission. Correct, ma'am. If you are if you are issuing debenture or if you are issuing any equity share, you have to pay underwriting commission. Right, ma'am. But for retained earnings, no need of underwriting commission. So that is the reason why you have to find out the cost for retained earnings. So KR equal to KE, the same. Why I'm taking KE? I told KE, the retained earnings are similar to equity. So KE 1 minus T. 1 minus T means 1 minus tax rate. Suppose my tax rate is, I told 50%. So 1 minus 50%, that is 50%. Then 1 minus B. So B is underwriter commission. Suppose if our broker commission is uh, 10%. So what is the answer? 0.9, 90%. That is 0.9. So that is a formula for cost of retained earnings. Even illustrated in my slide. So KR equal to the cost of equity. Already you are having, already you have computed cost of equity 10% into 1 minus tax rate. I am assuming tax rate is 50%. So 1 minus tax rate 50. 1 minus 50, 50%. And 1 minus a broker commission. Broker commission is 2%. So 1 minus a broker commission, so 0.98. So what is my KR? So KR only 4.9. So always my cost of retain as you ma'am asked, correct question only. My cost of retained earnings will be very, very, very lesser. Why it will be very lesser? It is my retained earnings. It is only my retained earnings. So I should not pay any dividend for this. So my almost it will be off off of my cost of equity.
So why are we getting here brokerage costs, sir? Like how?
I'll tell, ma'am. I'll tell, ma'am. I told ma'am. If you are floating the capital in the market, you have to pay underwriting commission. Correct, ma'am. But in the case of retained earnings, you need not pay any broker commission. That is the reason why it is reversed, ma'am. It is reversed.
Okay.
Suppose I am paying 2% broker commission, my investment will be 100. So I am not paying any broker commission. That will be my benefit, ma'am. That will be my income. In one way, it is somewhat notional income. So that is the reason why I'm reversing, ma'am. Correct, ma'am?
Yes, sir. Thank you so much.
Thank you, ma'am. Thank you. But whereas in the case of equity, I'm reducing the broker cost. Correct, ma'am? I'm reducing. That net profit will be got only after reducing the broker commission. But here I am not reducing, ma'am. I'm reversing, ma'am. I'm reversing. That is 2% is broker commission. My input will be 98, or 5% is a broker commission. My value is 95%. Like that, I am reversing because I am not paying any broker commission. That will be a income for me. So that is the reason I am reversing the value. Okay.
Thank you so much, sir.
Thank you, ma'am. Thank you, ma'am. Next, I'm moving into leverages. So, what is that? Another important one. So, leverage is employment of assets, employment of fund. For that, you have to pay the fixed interest. So, in utilizing the capital, how much fixed cost you have to bear. So, that is known as leverage. So what are the types of leverage? I told three types: operating, financial, composite, combined leverage, composite. So again, I'm saying, so leverage means how much you have to pay for the employment of assets, uh, the return you are expecting, or the cost you have to pay in the utilization of the asset. Suppose I'm saying, I'm issuing 10,000 debenture. So with the use of 10,000 debenture, how much income I will be earning? So that is known as leverage. So it will relate the income with the investment. So in other, I will put it in another way. In case instead of debenture, I'm using equity. How much income forgone? So that will be shown under the leverage. So, due to the mixture, due to the composition, due to the proportion of this two capital, that is debt capital and equity capital, how much change in the income that will be shown in the form of leverages. So that is the thing we are going to compute. Operating, I told whenever I am saying operating, you have to tell EBIT. Operating means the operating profit, that is earnings before interest and tax. So what is that operating leverage? Operating leverage associating the income activities with the operating profit. So with the utilization of fund, how much operating profit I am getting? So that is operating leverage. Or the company's ability to use operating cost, fixed operating cost, to magnify the sales. Or I'll say, for your easy understanding, a small change in EBIT, how it will be related with the sales, how it will be related with the turnover. Suppose, for your understanding, I'll say, suppose my I'm saying profit, you have to say only operating profit. So EBIT, earnings before interest and tax. Suppose my earnings is 100 and my sales is 5 lakh. Suppose now my earning is 110 and my sales is 6 lakh. So wha- what is the percentage increase? Can you say the percentage increase in sales? The percentage increase in sales is 20%. Correct? Do you accept or not?
Yes, sir.
1 lakh divided by 5 lakh. Correct, ma'am. 1 lakh divided by 5. my sales increase is 20%. And what is my profit change? My profit change is 10%. So for every change of 20 percentage sales, there is a change of 10 percentage. So this will be reflected. This will be monitored with the help of the operating leverage. So what is operating leverage? It is a link. It is a connection between the profit and the sales. How much profit I am gaining out of the change in the sales. That is known as the name suggests, operating means turnover, operating means sales. Okay, I'm coming to the formula. Operating leverage equal to contribution means what? Sales minus variable cost. So you should take fixed cost. Why I'm neglecting fixed cost? Can you say? I'm not considering the fixed cost. Say why I'm eliminating fixed cost. I'm taking only the sales minus variable cost. Contribution equal to, as you know, contribution equal to sales minus variable cost. Why I'm ignoring fixed cost?
Because it is going to be fixed. The sales, I mean, the production of units is not going to influence the fixed cost. It is going to be, no matter how much I'm producing, the
Yes,
fixed cost will stay the same.
it will be constant. Correct, ma'am. Say for example, rent. Even though there is no production, you have to bear the rent or depreciation. So even though there will be wear and tear in the machinery, so it will be fixed. It will not be directly linked with your operation or even salary. You have to pay salary. Even the workers in the strike, you have to pay the salary to the manager. So it will be fixed. That is the reason why I'm ignoring the fixed cost. Very good, ma'am. So what is the relation between the operating leverage? Operating leverage equal to C by EBIT, contribution divided by EBIT. So contribution I told. What is contribution? Sales minus variable cost, or the profit plus fixed cost. I'm linking the profit with the profit before interest, or profit before interest and tax. I'm correlating the profit with the EBIT. That is operating leverage. So what is a degree? Just now I told, degree. Just now I told. With my example, I told. What is the change in profit? Every change in the sales, that is known as a degree means that level, how much it was affected by every change in the sales. So you are taking sales as a base. So for every sales change, what is the change in the profit? That is a degree of operating leverage. So in your examination, they're asking what is the magnitude, what is the level of operating leverage. The formula is C divided by EBIT. In case they are asking degree of operating leverage, the percentage change in the every percentage change in the sales. Okay. Now I'm moving into the finance. The name suggests, financial. So financial leverage means this is a degree of financial leverage, or financial leverage equal to operating. Just to reverse, in the previous, the operating profit in the denominator, but now it will be in the numerator. Operating profit divided by profit before tax. Profit before tax, but after interest. So what is financial leverage? As you know, for every change in the debenture interest, for every increase or decrease in the debenture interest, what is your profit? What is your change in the profit? That is known as financial leverage. See, in the previous, I'm not taking the change of the interest. That is a operation. Operation means what? The sales. So I'm correlating with the sales with here. Financial means what? Interest. So I'm correlating the interest with the change of the interest with the change of the my profit. So that is the reason why why I'm saying you should not confuse with this two type of leverage. In your examination only that confusion will be coming. So that is the reason why I'm differing the two types of leverages. Okay, so operating EBIT divided by profit before tax, but after interest. So what is the degree? The change in the profit after interest divided by the change in the profit before interest. Percentage change in the taxable income means what? Profit after interest, but before tax, divided by the percentage change in the profit before interest as well as before tax. So what is the change? Suppose I am saying, suppose your your profit is 10 and your EBIT is 100. Now your profit is 15 and your EBIT is, suppose I am saying, 200. So what is your degree? What is your degree of financial leverage? For every 100 percentage change of profit before interest and before tax, there will be how much change? How much change in taxable income? What is the change in taxable income? This is 100 percentage, in between 100 and 200, twice, twice means 100 percentage. So here, what is the change? 50 percentage, correct? 10, 15. That means what? 50%. Even I'll compute. If you put it able to understand, I'll say. So what is the change? 15 minus 10 divided by the original value. What is the original value? 10 into 100. That is equal to 5 by 10 into 100. 5 by 10 into 100. That is equal to 50%. Correct. This is 50%. So 50% is a change in the taxable income. So what is the change in the EBIT? EBIT is 100 to 100. So what is the change? So the change is, difference is 100 divided by original value 100 into 100. The change is 100%. So what is the degree? What is the degree of 1 by 2 of? So 1 by 2. So this is a formula for degree of why I'm saying these are all the things asked in your examination. Okay, what is a combined leverage, composite leverage? As you know the formula. So what is the formula? Contribution divided by profit after interest but before tax. So that is the formula for composite leverage. Again, I'm saying composite leverage equal to, or combined leverage equal to, contribution C divided by profit after interest but before tax. Okay. Now I'm moving into dividend. As you know, dividend is a return to the shareholder. It's a part of profit. It is a part of profit, or after reserve, you can pay the dividend. It is a periodical payment for the utilization of money of the shareholder. What are the kinds of dividend? Cash dividend. Yes, it is usually the company will pay the dividend with the okay. And the stock dividend. Stock dividend is otherwise known as what? Bonus share. Bonus share is otherwise known as stock dividend. Bond dividend, if dividend given in the form of debenture, that is bond dividend. Property dividend will be paid at the time of winding up. The company will issue assets. It will give assets like a land in the form of land. It will distribute its assets to the shareholder. That is property dividend. What are the theories? This is very, very important. I will say what are the theories. First one is irrelevance theory. What are the theories coming under irrelevant? Irrelevant means what? Uh, Whatever may be the dividend, your value will be stable. You are paying 50% dividend, you are paying 100% dividend, you are paying 200%, 300, whatever may be more dividend, any kind type of any value of dividend, nothing will be reflected in your firm value or market share. That is known as irrelevant theory. Irrelevant theory. What are authors coming under irrelevant? Solomon theory, MM theory, to keep in your mind. Even when I'm saying capital structure, so under capital so NY approach, approach, irrelevant. Irrelevant with the capital structure. In the same way, the irrelevant with your dividend. What are the theories? Solomon MM is very, very important. Same arbitrage process coming here also. Okay. Same thing, approach I told, based on the assumption. I told perfect capital, investors are very, very rational. They are very having the knowledge about the share market. They are very rational. They are aware about the market sensitivity, and no corporate tax. These are all the things I already told. The firms has fixed investment policy, stable, no risk. This all the assumption by approach. What is the formula for approach? PO. PO is the current market price of share. So there that will be constant. PO equal to D1. D1 means what? Dividend after 1 year. After 1 year. Dividend received after 1 year. Plus P1. P1 is a market price of share after paying dividend. After dividend, what is the after paying dividend, what is your so that will be coming under P1. P1 means after dividend. P0 means before dividend. So before dividend, what is your market price? P1 is what is your market price after paying dividend? KE, I already told, cost of equity. D1 dividend. Dividend issued by the company. Dividend paid to the company. So by the way, you can get the PO. So the PO will be stable. There not be any change in the price of the company. Whatever may be the dividend, you are paying higher dividend or lower dividend or even no dividend, the price will be stable. That is irrelevant. What are the theories coming? Two theories. Solomon, another one is So IR equal to irrelevant equal to S comma M. So S means Solomon theory, M means Modigliani Miller approach. Next, I'm moving into relevant. So relevant means what? The more dividend, more worth of the firm. The shareholder wealth will be increasing. So that is a relevant theory. Uh, Gordon model, Walter model, all are James, all are coming under relevant theory. So you have to keep in your mind. That is G W are coming, James, all are coming under relevant. So more dividend, yes, the value of the firm will be more. There will be more amount, more in the more in the value, more value of the firm. Okay. So what are the assumptions in the Walter model? What is Walter model? It will be relevant. It will be relevant with your dividend policy. So if your dividend policy is very leniency, if you are maintaining a lenient dividend policy, yes, that be value of the firm will be more. Formula: price of share equal to dividend dividend you are paying plus return on your investment. Your return divided by KE. KE means cost of earnings, cost of equity. Sorry, cost of equity. KE means cost of equity. Then multiplied with the difference, or the difference between the earning per share minus dividend per share. So earning per share means before dividend. Earning per share means before dividend. Dividend per share means how much dividend you are paying. So earning per share will includes retained earnings, reserve. So that will be, so EPS equal to, again I am saying what is EPS? Earning per share equal to any answers. What is the EPS? Can you say EPS? Also P is that. P means price earning ratio. So that formula repeatedly asked in your examination. EPS and a P ratio that will be asked in your examination. Those things are important in the case of financial management. Okay, what is EPS? Can you say the answer?
Earnings per share.
I'm asking a formula, ma'am.
Okay.
Um,
So,
earnings available
EAT,
to equity shareholders. Sorry, earnings
Uh,
available to equity shareholders by
very
number
good,
of
ma'am.
equity shares.
Very good, ma'am. Very good, ma'am. Very good, ma'am. So earnings available to equity shareholder means the profit before reserve, ma'am. Before appropriating reserve. Correct, ma'am. Before available for reserve. Before appropriating for reserve. But I told you no PE ratio. So PE ratio is entirely different from EPS. Can you say PE ratio? Price earn.
Market price
Very good.
by
Divided by.
earning,
Very
earning per
good, ma'am.
share.
Very good, ma'am. Very good, ma'am. That is the reason I'm saying. So market price divided by earning per share. So that will reflect the value of the shares. That is PE ratio. Can you say payout ratio? These are all repeatedly asked in your examination. Payout ratio. Payout.
DPS by EPS.
Very good, ma'am. Can I say in this way, ma'am? Dividend paid divided by profit available. Divided by profit available. Correct, ma'am. How much you have paid as dividend out of your profit? That is payout ratio. These are the things I'm expecting in your examination. That is the reason why I'm asking. Very important. Okay, Gordon's model. I told you, know it is also relevant. Relevant. Gordon's model relevant. More dividend, more firm value. So price of the share equal to E. E, as you know, just now you told EPS, earning per share, 1 minus B. What do you mean by B? I told you know earlier. I told. So B means payout ratio. Payout ratio. Just now you told B refers payout ratio. How much you are paying. So divided by KE minus BR. BR means growth rate. It will be given in your problem. BR equal to growth rate. So this is a formula by Gordon's model. So the price will be increasing. The price will be increasing out of the dividend. So even if you couldn't able to remember the formula, at least you have to remember what are the theories coming under relevant and coming under the irrelevant. Also in the capital structure. So what is coming under relevant? Relevant in the capital structure and also dividend. Very, very important. These are all the things they will touch in your examination. Again, I'm saying Solomon method theory, Solomon approach, approach, molecular approach, irrelevant. But Gordon model, all are coming under relevant. Walter model, even Walter model, all are coming under relevant. Okay. Next, I'm moving into capital budgeting. See, what is capital budgeting? How much you have to invest in the long-term investment. So it will decide the quantum of investment, the decision in the case of long-term investment, like machinery, plant, or land. So it will be useful for investment of long term source. That is capital budgeting. Okay. What are the techniques? So six techniques are there, but yes, two techniques are traditional and three techniques are modern. What are the two techniques traditional? PP method, payback period method, average rate of return method. These are all coming under traditional. What is modern? Modern method is otherwise known as what? Discounted method. Discounted method. Or I'll put it in another way, the time value of the money will be considered. What is time value? Can you say in simple way? Time value is otherwise known as what? The time value will be ignored in traditional method, and the time value will be considered in the modern method or discounted method. What is time value? Can you say in simple word? What is time value?
The 10 rupees worth like is not the same like as it was before, like 2 years. So the value has depreciated.
Value was depreciated, ma'am.
No, sir, increase.
Increased. I will say in easy way, ma'am. The interest, ma'am. The interest. The interest
So,
is known as time.
sir, 1 minute.
Oh,
Sir, today 1 rupees invested in future, that value is increase.
yes, ma'am. Yes, sir. Yes, sir. Obviously, sir. So that the time value equal to the interest. The interest. Suppose I will give you example. What you are saying is absolutely right. Suppose I am saying, suppose today I am giving 100 rupees. Oh, sorry, 10 lakh. Today I am giving 10 lakh. After 5 years, I am giving same 10 lakh. So which amount you can accept? Which one will be you are preferring? Now I am paying 10 lakh. After a few years, I am paying 10 lakh. Which amount you can expect?
No.
Now, the reason is time value, or the reason is the money will have the value after years. So I'm saying the important thing. Suppose from now you are going future. From now you are going the future. You are finding the value of the money in future. What process you have to do? You have to do, in order to find the value, you have to do the compounding. You have to do the compounding. Suppose if you are in the future and if you want to find the value of now, suppose I will tell the example in the 0 year. 0 year means now. After 5 years, I'm getting 3 lakh. 3 lakh. So I want to find the value of now. What is the value of 3 lakh now? What I have to do? I have to do discounting. Correct? These are the things done by the bank. If you are availing loan, these are the calculation they will do. So that is known as discounting. So discounting means what? You are going back. You are computing the value of the money in the back. So that is known as discounting. Suppose if you are computing the value of the money after some years, now you are investing 1 lakh in a FD. What is the value after 1 year? You will do compounding, compound interest, compounding. That is interest on interest. So this is what you have to keep in our mind. That is the items coming under while we are discussing of time value of money. Right. Could you able to understand what I am saying? It is in your understandable level or not? I am saying difficult things. It is understandable or not? Could you able to understand what is discounting and compounding?
Yes, sir.
Good, ma'am. Fine, ma'am. Okay. So again, I am saying discounting means from now you are computing the value of future, the value of the money in future. That is known as compounding. Suppose if you are computing the value of the money before some years, so that is discounting. Okay. I have to say what is a payback period. Payback period, very easy method. In how many years you can get back the investment? In how many years? So it will be in the form of years. So none other methods in the years. This is the only method in years, but it will not consider the time value of the money. Time value of the money. Suppose I am investing. A simple example I will give. I'm investing one project 10,000, another project 20,000. In one project, in the first project, I'm getting a return of 5,000. In the second project, I'm getting the return of 5,000, same 5,000. Which project I will select? So again, I'm saying the meaning payback period means that will show the period within which I will recoup my investment. I will recoup my original investment. I will get back my original investment. So it will show the gestation period. So the gestation period will be reflected with this method that is known as payback period method. Correct. In my example, which project I'll choose, whether 10,000 project or 20,000 project?
10,000 projects, sir.
Why, ma'am? Why, ma'am?
Because of the 50% of investment we are returned.
Always, ma'am. In payback period, we have to see in years, ma'am. We have to see in years, ma'am. So even I'll tell the
Only 2
form.
years, sir.
2 years, ma'am. Yes, ma'am. Very good, ma'am. I'll tell the formula: investment divided by annual inflow, ma'am. Annual cash inflow. Correct, ma'am. Annual cash inflow. This is a formula. So whichever is least, kindly note my word, whichever is least, that will be accepted in my method, in my decision making. Whichever is least. Okay. So 10,000 divided by 5,000, 2. 20,000 divided by 5,000, 4, whichever is least. So project A is acceptable. And moving to ARR. ARR, very simple. As in the case of return, as a return on investment, same formula. So average cash inflow divided by outflow into 100. So whichever is higher is acceptable. Whichever is higher will be the your decision making. The coming under ARR. Coming to NPV, in the case of NPV, your total cash inflow. What is cash inflow? The present value. You have to compute the present value. Suppose if you are earning 1 lakh in the first year, what is its present value? Its present value will be 90,000. I told the present. If you are computing present value, I told the keyword discounting. If you are computing the future value, what is the process? Compounding. So always you have to find the discounting. You have to find the present value of cash inflow. So total cash inflow in present value minus cash outflow. The positive, the project which is positive, more positive value, that will be accepted. Correct. Even I'll say the formula, how you are computing the present value. PV equal to present value of cash flow equal to, can you say with me, what is the formula? Cash flow divided by 1 plus R percentage. R means what? The rate. 1 plus R, the rate. Suppose my cash flow is 1,000. divided by what? I will divide with rate is 10% means what? 1.1, correct? 1.1. Suppose my rate is 25%. That means what? Divided by what is in the denominator? 25% means 1.25. Suppose my rate is interest rate is 12%. What is in the denominator? Uh, Divided by 1.12, correct? So this is the discount. Even I'll say the example. Suppose my 10,000 divided by 1 plus my interest rate is point 0.1. So 10,000 divided by 1.1 divided by 1.1. So my value will be 90,000. My value will be 10,000 means 9,000. 9,000. This is a discounted cash flow, the present value of the cash flow. In this way, you have to compute the value of all the years. Suppose if you are a project for 5 years, you have to compute. So what is the formula? Again, I am telling NPV equal to total cash inflow minus outflow. So cash inflow in the present value. Okay. And next I'm moving into PV. So profitability index, same formula, friends, same formula. So what is the same formula? Present value of cash inflow divided by cash outflow. That is cash outflow means what? My investment. Cash outflow means my investment. Please note my word. Always my answer should be greater than one. That is my criteria of accepting the project. Always it should be greater than one. And coming to IRR, IRR means what? IRR is a rate at which the cash flow and the cash inflow and the outflow will be equal. It will be equal. It will be same. Or otherwise, I will say IRR is the cost of capital. That is my return, my expected return, my profit percentage. So it is a rate at which, again, I am saying IRR is a rate. It is a cost of capital, or it is a rate at which my cash inflow and the outflow will be equal. Suppose I will tell the example. Suppose my now I am investing 10,000. After 5 years, after 5 years, my return will be 15,000. See, I told you, no, I have to discount. I have to discounting the amount. I have to discount the 15,000 in order to reach this 10,000. So I have to discount the amount in order to reach now money, present money. So that discount rate will be called as IRR. That discount rate is called as IRR. So what is the criterion? The IRR more in any project that will be accepted. The company in which the IRR is more, that will be accepted. So these are all the different methods. But I'm saying, what is profit? I'm saying cash inflow. Cash inflow means what? Maybe asked in your example. Cash inflow. I'm saying cash inflow means profit, the return. So what is return here? What is return here? So return here refers, kindly note, profit after tax, adding back the depreciation, before depreciation. So after tax, before depreciation. Meaning of the term uh, cash inflow. But only in the case of ARR, ARR it is different. Cash inflow means it speaks different meaning. So what is the cash inflow in ARR? Cash inflow in ARR equal to profit after depreciation, after tax. So this things may asked in your checked in your examination. See, always cash inflow means what? You may refer. It will be called as profit after tax before depreciation. because depreciation is a non-monetary. No, this is non-monetary expenses. You are not paying the depreciation to anybody. So that is the reason why you are adding back the depreciation with your profit. So that is a normal one. Whereas in the case of ARR, you are computing the profit after depreciation, after tax. So the difference you should know. These are all the things asked in your examination. Okay, then I'm coming to next. I'm coming to yes. What are the working capital approach? What are the different approaches in the working capital? Very important. Hedging approach, conservative approach, aggressive approach. So what is this very important, friends? Kindly note, if difficulties are there, you can say. Okay. So what is hedging approach? In the case of hedging approach, you can match, you can offset, you can adjust the long-term investment with the short-term investment. So you can use the long-term money for the fixed assets and the short for the working capital. So it will not be mismatched. It will not be mismatched. That is known as hedging. Hedging means what? Adjusting. So suppose I'm saying, if you are getting money from equity capital or debenture capital, it will be used only for land, only for machinery. Suppose if you are getting money from creditors, or if you are getting money from short term, that is, I'm saying current liability. So current liability will be used for current assets. So short term money will be used for short term asset. So that is known as matching approach. It will not be reversed. Whereas I'm moving into conservative approach, as the name suggests, So conservative approach in this case, the short-term investment will be done from any sources. It will be used by any sources, by fixed capital or short-term capital, like short-term loan, like that. So if with any amount, you can use current asset. You can buy stock, you can buy raw material with the help of share capital, or with the help of the loan, short-term loan. That is conservative approach. Conservative, as the name suggests, So it will be you are acting in uh, a safe manner. So that is conservative approach. I'm coming to aggressive approach. In the case of aggressive approach, the current asset will be financed 100% from the creditor or from the short-term loan, and few of the amount will be from the fixed assets. Few of the amount will be utilized from the fixed capital. So that is known as aggressive approach. So this will be more risky. Again, I'm telling three approaches are there: matching approach or hedging. So here the long-term capital will be used for long-term investment. That is fixed assets. Short-term capital means what I'm saying. Bank OD, creditors. These are all coming under short-term. Short-term. But long-term will be used for this. But conservative, any capital can be used for any investment. Aggressive means what? Same matching, but a few amount will be used for short-term investment. That is working capital. So these are all the techniques in managing the I'm saying for stock management, inventory management. Maybe in cost accounting, I will say cost accounting ABC. ABC means always better control. So 90% value, 10% weight, that will be coming under A category, and middle 50-50, that will be coming under B category. C category, more weight but less value. That is C category. You are categorizing your stock for the importance, for giving importance. Three categories: A category, B category, C category. In the same way, you are categorizing the stock in the VED. VED means what? Vital product. Vital means very important. Without this, you can't do the production. Vital, essential, desirable. So vital means what? The spanner, screwdriver. Without this, you can't do the repair of the machine. Vital. Essential means what? The grease, oil, like that. Desirable means what? It will be may or may not. Without this, you can do the operation. That is desirable. So in this way, you can categorize the stock, and high value, middle value, low value, HML. Aging schedule. Aging schedule means the based on the period. So these are the different ways of your inventory management. Okay, friends, with this I will stop. If any doubts, you can ask your doubt. Uh, Regarding the financial management is very interesting. Not only interesting, many things, many concepts we have to see. Okay, if any doubts are there, you can ask. Otherwise, we'll continue tomorrow. So tomorrow I'll ask. I think Narayanan sir will do HRM. I will ask his uh, availability of time. Uh, okay, friends. Good night, and we'll see you tomorrow.
Thank you, sir. Good night,
Thank
sir.
you, ma'am. Thank you,
Good
ma'am.
night,
Good
sir.
Thank
night.
you, sir. Good night, sir.
Thank you. Good night, sir. Good night, sir.
Thank you, sir. Thank you.
Thank you, ma'am. Thank you, ma'am.